Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 65 on June 8th, 2019. I'm your host, Eric. And in this week's show, we will cover the trades from last week on the Gold Miners Index, Wells Fargo, and Devon Energy. And we also discuss three new trades on Luckin Coffee, Activision Blizzard, and Occidental Petroleum. Now, it's always great to hear from listeners. If you have any questions about the trades presented here or about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC at theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to be able to understand in order to follow along with me on this show. You can visit our website and click on the videos tab to watch those videos, or visit the YouTube channel for the Weekly Option. Now, this was a very strong week in the markets. In fact, we haven't seen a week this strong in terms of bull market since November of 2018. The Dow Jones Industrial Average closed 1,168 points higher, or 4.7% higher, finishing the week at 25,983 points. The S&P 500 index was also up more than 4%. The index ended at 2,873 points, and that's 121 points higher. Now, the topic of the week is sponsored by the Option Studio. If you want to learn to trade options without any calculus or confusing language, visit the website to learn more about the online course. Visit www.theoptionstudio.com for more information. Now, the topic of the week this week is getting long or short the market with options. Now, after you've been trading options for a little while, you get good at knowing which trades profit when the market goes up and which ones make money when the market goes down. We all know that puts increase in value as the market goes lower and call options appreciate when the market goes higher. But let's take it one step further. So what trades do we put on if we think the market is going up? Well, of course, there's buying call options, right? So those appreciate as the market goes higher. But buying call spreads also appreciate as the market goes higher. What about with puts? Well, you actually have to short puts, short put positions or put positions that you sell actually increase in value as the market goes higher, as do short put spreads, right? Sometimes it's hard for people to wrap their minds around selling a put and how that increases or maintains its value as the market goes higher. So which trades make money when the market goes lower? Well, of course, put options increase in value as the market goes lower. So buying puts is your first bet, right? So being long the puts increase as the market goes lower. Also, buying put spreads. So being long put spreads also is a trade that increases as the market goes lower, or a short spread, a short trade rather. And then, of course, on the call option side, being short call options and being short call spreads, those both make money as the market goes lower. So going one step beyond that, the next step to consider is creating option trades that use a combination of call and put options to create a position that completely replicates stock. It's a synthetic stock position, and it can be used whether you want to replicate owning stock or short selling stock. So if you're looking at buying stock, but you want to use options instead, you can create a scenario where you might be able to buy a call option and sell a put option to cover the cost of that call option, and you actually end up creating a position that looks like owning stock, but you may not pay as much money. You'll pay less capital to benefit from moves in the stock market than you would if you just bought the stock sometimes. And as well, the opposite is the synthetic short stock is when you sell a call option and buy a put option. So Anyway, once you really understand that and wrap your head around that, it'll help you in your option trading because you'll understand how to create the positions you want that will benefit as the market is moving one direction or the next. Now let's dive into this week's trade review. And this was not the best week, just coming off of our topic of the week. We had sold a call spread and we bought a put spread. So which way do you think we made money in a week where the market is up 4%, or do you think we lost? So consider that your cliffhanger for the week, or your little bit of foreshadowing of what's to come. So we always start off with our covered call, and we looked at Direction Daily Gold Miners Index, symbol NUGT, Nancy Uncle George Thomas. The stock at the time was trading for $17.08, and we looked at buying that stock and selling the June 17 half call at 95 cents, creating a 7.9% return in 3 weeks, ideally. Now, the Direction Gold Miners Index rose $3 this week, $3.04, ending the week at $20.12. The call that we sold, the call option that we sold for 93 cents, can be bought back if you were to close the trade for $2.85, which is a loss of $1.92 per option. So all in, with the stock above $17.50 per share, we are set to collect a total of $1.35 per option if you let this go to expiration. Now, there's a good chance that you haven't been assigned on the option yet. And it's not just expiration that will do it. Actually letting this thing, if you get assigned on the stock, you also will collect that full trade value of $1.35. Now, if you haven't been assigned on the option, that means that you still have some time. So you can actually buy that option back and then sell the stock. So if you don't want to wait the additional 2 weeks for June expiration, you can lock in $1.12 per option by fully exiting the position. That's still 83% of your total expected return for just 1 week of exposure. And I always think in terms of exposure or amount of risk and time, right? Because in option trading, we always look at time as a factor. So if you want to wait for 2 more weeks, you will likely collect the full expected amount of $1.35. But if you don't want to wait, you can exit the position right now and try and lock in that $1.12 per option. Now, our next trade really was a credit spread on Wells Fargo, symbol WFC, William Frank Charles. Stock last week was $44.37. And we looked at selling the June 44.5/45 call spread, collecting 22 cents, which could lead to a maximum loss of 28 cents if the stock moved against us. Well, Wells Fargo stock rose $1.26 this week, ending the week at $45.63 per share. The out-of-the-money call spread we sold is now in the money, and the spread we sold for 22 cents is now priced at 41 cents if you try to exit the trade. So that would be a loss, a mark-to-market loss really, of 19 cents per spread. Now there's still another 9 cents that can be lost in this spread, so it's probably worth buying the spread in. However, for those of you willing to carry a little more risk, or if you want to add to this position, it may pay off to stay in the stock over the next week or so. The stock has not broken out of its current price channel or its price trend when you look at it technically. That means we might see this stock make new lows in the coming days. As well, there's an FOMC, or the Federal Open Market Committee meeting the week of expiration. That's the group within the Federal Reserve Bank that decides the prime rate or the interest rate that people discuss. So the market seemed to be expecting the Federal Reserve Bank to lower rates by 25 basis points and possibly entering a trend where they're going to continue to lower rates through the end of the year. That will be followed by a slew of negative economic data that justifies the Federal Reserve Bank's position, and that would have this stock trail off prior to expiration because the meeting is on June 18th and 19th, and expiration for this stock or for this option is Friday, June 21st. So the fact that there are only 2 more weeks in June makes me look at staying in this position a little longer to see whether it turns positive. I much prefer to keep the risk in the same month. So some people would consider rolling the risk or rolling the spread into July so that you have a little more time. You certainly could buy the spread back and sell it spread in July if you want to do that. But I like to keep all of my trades sort of my thought, unless it's a position that I really intend to hold and trade for the long term. I much prefer to have it all resolved within the month that I entered the trade. So that's it for Wells Fargo. My next trade was a debit spread on Devon Energy Corporation, symbol DVN, David Victor Nancy. At the time, the stock was trading for $25.16. We looked at buying the June 26, 25 half put spread for 34 cents, which could lead to a maximum gain of 16 cents or 47% return in 3 weeks. Well, Devon Energy stock is up 53 cents this week, ending at $35.69 per share. The in-the-money put spread, which we bought, is much less in the money now. The spread could be sold for 22 cents, which would lock in a loss of 12 cents per spread. This is another one of those situations where you'll have to assess your own tolerance for risk. You can lock in a small loss and walk away, right? You can sell a call spread to try to cover the loss. You'd cover the price, the dollar price of the loss. So the June 26 call spread can be sold at 15 cents, which would put this overall trade back in a position of profit. This stock chart doesn't give me any true indication that it's heading higher. So I'm actually comfortable selling that call spread in June, which has two more weeks, and then staying in the put spread. Now, that is extremely risky because it doesn't lower my risk. In fact, selling that call spread simply adds to the risk. I would be long a put along the put spread and short the call spread, which is still one directional trade. That still is a position that increases in value as the market goes lower. Now, to lower the risk, you can look at selling the June 24 half put spread for 13 cents. Selling a lower put spread against the put spread we already own would be a hedge. So that's why it's important to understand options. Some of you may have thought that selling that call spread was a hedge because I bought a put spread, but that only adds to the risk. They both benefit from the same move in the market. A long put and a short call combined for a synthetic stock. So it's the same way. If the stock goes up, I could lose money on both the put spread and the call spread that I sold. So the put spread that I own and the call spread that I sold. And if the stock went lower, I could earn money on both spreads. So to hedge a long put spread, you need to sell a put spread or actually buy a call spread. Now, we'll get into the trades for this upcoming week. We have 2 more weeks left in the month of June expiration. So this will likely be the last week that we discuss June trades. We're going to start off right off the bat with the recent IPO for our covered call. We're looking at Luckin Coffee. It was the symbol is LK, Larry, Kevin. The stock ended the week at $18.99. Looking at buying that stock and selling the June 20 call at $1.15. That creates a maximum possible return of a little more than 11% in 2 weeks. You would enter this trade by buying Luckin Coffee stock for $18.99 and then selling the June 20 call at $1.15. This trade makes the most money if stock prices finish above $20 per share. The break-even price on this trade is $17.84. Now, this company is the Chinese Starbucks, essentially. It had a recent IPO here in the U.S., and that's the initial public offering. And that led to some initial stock volatility. Now, if a trade war truly persists with China, I would imagine this stock going higher as tariffs on all American goods, including Starbucks coffee, could limit foreign coffee brands' ability to be competitive in China. In that scenario, Luckin Coffee stands to truly benefit from being having home court advantage. Now, the next trade I'm looking at is a credit spread on Activision Blizzard, the gaming company. The symbol for this is ATVI, Adam Thomas Victor Isaac. Stock ended the week at $45.38. I'm looking at selling that June 46.5 call spread at 14 cents, which leaves us with the maximum possible loss of 36 cents on the spread over the next 2 weeks. Now, of course, I typically require at least 15 cents to sell this sort of spread, but I chose the strikes that are a little further away from the at-the-money spread to try to provide a little bit of cushion. For that, I'm willing to give up a penny of my normal trade values for extremely short-term trade. This is a 2-week trade. So you enter this trade by selling the June 46 call at 91 cents and buying the June 46 half call for 77 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices stay below $46 per share. The break-even price is $46.14. And then our last trade on the week is a debit spread on Occidental Petroleum, symbol OXY, Oscar X-ray yellow. Stock ended the week at $47.84. And I'm looking at buying the June 48 half, 48 put spread, paying 34 cents, looking for a maximum possible gain of 16 cents or 47% return on my capital in 2 weeks. Now, you enter this trade by buying the June 48 half put for $1.48 and concurrently selling the June 48 put at $1.14. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices stay below $48 per share. The break-even price on this trade is $48.16. Now, that's it for this week's show. Thank you guys for listening. If you have friends that also trade options, please share it with them, tell a friend, and I look forward to seeing how these trades work out, and I'll see you guys on next week's show. If you have any questions, email me. My email address, of course, is eric@theweeklyoption.com. eric@theweeklyoption.com. Happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.